So you're making good money, even cross the six-figure mark. You've cut back where you can, you've got a budget, but you're still not building the kind of wealth you thought you would. Sound familiar? That's because most standard financial advice is totally broken. It's designed to help you tread water, not make you rich. The truly wealthy don't just earn and budget. They operate on a completely different set of rules, a playbook that lets them build serious wealth without a life of miserable sacrifice. And after years of studying the habits of the financially free, I'm sharing that playbook with you today. This isn't about earning more. It's about making your money work for you in a fundamentally different way. The new 35% rule. First things first. It's time to throw out the old 50-30-20 rule. You know, the one 50% for your needs, 30% for your wants, 20% for your savings, okay? We're throwing that out. Let's be honest. That rule is a recipe for staying afloat, not for getting ahead. High earners who actually build wealth flip this idea on its head. They aim for something closer to 40% for their needs, 25% for what they call controlled wants, and 35%, a massive 35%, gets aggressively plowed into savings and investments. For higher earners, the portion of income needed for basic necessities is often lower, creating a huge opportunity by consciously capping your lifestyle spending and deducting 35% or more of your take-home pay to wealth building. You're putting your financial goals into overdrive. You're telling your money that your future is a bigger priority than your fleecing wants. That game plan, review your spending each month. Cut out the waste. Pay your investment accounts first, okay? Here's the second secret. It's all about how the wealth handle new money. For most people, when we get a raise or bonus and it hits the account, they fall right into the lifestyle creep. Suddenly, their spending magically inflates to match their new income. The wealthy see a pay bump not as a chance to spend more, but as fuel to build their wealth engine faster. Here's the rule they follow. For new income earners, okay, for new income that comes through, 50% is immediately sent to wealth building assets. 30% is used for specific goals like paying down a mortgage or saving for a big purchase, and only 20% is allowed to be absorbed by lifestyle upgrades. This discipline is what separates the high-income earners from the truly wealthy. It lets you enjoy some of the fruits of your labor while ensuring the vast majority of your new money is building your asset column, not your expense list. Now we're about to get into how the rich really invest their money, and it's probably not what you think. If you're getting value out of this, do me a favor. Do me a solid. Hit the subscribe button so you don't miss what's coming next. Here's the third secret. It is an understanding that your 401k and the few index funds that are the beginning of all of this, the average investor is told to pour everything into the public stock market. But the ultra wealthy are playing a very different game. They often allocate a significant chunk of their portfolio, sometimes as much as 46%, to what's called alternative investments. These are assets outside of the typical stocks and bonds. We're talking about private equity, where they invest directly in promising private companies, venture capital, getting into startups with huge growth potential, and private credit, which is basically lending money directly to businesses. Another massive category is real estate, which provides both cash flow and a hedge against inflation. Now, you might not be buying a company tomorrow, but you can apply the principle today. You can get exposure to real estate through REITs, real estate investment trusts, or explore crowdfunding platforms that offer access to private credit or venture capital funds. The goal is to diversify into assets that don't always move in lockstep with the stock market, which helps protect your portfolio when things get rocky. This last secret is the one that feels the most backward. The wealthy don't fear debt. They use it. But they use it in a completely different way than most people use it. While the average person uses debt for consumption, financing cars, phones, vacations, all of that plummets in value. The wealthy uses debt strategically as a tool for leverage. They borrow money to acquire assets that either go up in value or generate cash flow. The classic example is using a mortgage to buy an investment property. The bank puts up most of the capital, but the investor reaps the rewards from appreciation and, of course, rental income. Their return on the actual cash they put in is magnified. A low fixed rate loan is seen as a weapon against inflation. The debt payment stays the same, while the asset's value and the rent it generates can both rise over time. This is a complete mindset shift from seeing debt as a burden to seeing it as a calculated tool multiplying wealth, okay? So let's bring it all together here. First, you're going to ditch the 50-30-20 rule and start saving at least 35% of your income. Second, next time you get a raise, you will portion at least some of it, let's say half of it, directly into wealth building. You'll start thinking like the rich by looking for investment opportunities beyond just stocks and bonds. And finally, you will learn to see debt not as a trap, but as a strategic tool to acquire assets. Building life-changing wealth isn't about extreme sacrifice, and it's not just for people with million-dollar salaries. It's about adopting a smarter set of rules. It's about being intentional with every single dollar. You've got the income. Now you've got the playbook. If you found this helpful, give this video a like and drop a comment below the one secret, all right, you're going to put into action first. Tell me about it. Tell me which one it is. And don't forget to subscribe for more insights on building lasting wealth. I'm Grant Stinchfield. Thanks for watching.